Ladies and gentlemen, please welcome Scott Wapner and Rick Rieder.
Thanks, everybody. Good to be back with you again. My third year at Future Proof. I think this is Rick's first.
It is.
And it is a treat to have Rick Rieder here. He's so well respected on Wall Street, followed by everybody, and he talks to everybody. So what he tells you, he is sharing with the greatest investors in the world, and he is hearing from the best investors in the world. So thanks for being here.
Oh my God, it's awesome. Thank you.
So,
can I stay?
What's that?
Can I stay?
Yeah, seriously, nice backdrop. Beats the hell out of where I do my show from every day. At any rate, where I do my show from every day is the New York Stock Exchange, and it's where you made news recently with me. Let's discuss what you told me recently and how you looked at the current investing landscape, in which you described it to be one of the best you'd seen in an awfully long time, if not ever. Can you share in context with what you meant and why you feel that way?
So, by the way, I said, I don't know how many people watch your show. I've never said anything ever anywhere that has gotten so much. My wife kept saying, I don't know what you said, but this thing keeps going. Anyway, can I show these slides?
Yeah.
So I only have 3 slides. For people that know me, I usually have hundreds. So this is very short. But anyway, I'll just throw it out, and because it did get a lot of play. I do believe it's the greatest investment environment I've ever seen. Not necessarily because I think the market's going to fly higher equities from here, but the fact I've been doing this for a long time, for decades. You had the Fed funds rate at 0, you had negative interest rates in Europe. Today, I just show portfolio, this is a model portfolio I run our ETF called BINC or SIO, our mutual fund. You can create a portfolio with over 6% yield with a duration under 3 years and a volatility of 2.5%. The reason why these funds grow is that if you keep your vol down, you keep your volatility down, you can get 6%. If you're an endowment, foundation, pension, and for years you had to buy venture, you had to buy real estate, now you could get almost 7, almost your total return target. And I show these charts where I have the stars. For 20 years, we spent, where that orange part of the bar, where the blue part of the bar is, we spent almost 50% of the time with the 2-year under 1%. The 2-year has rallied to 355. It's still pretty darn good. So from an income point of view, it's the best. And by the way, you can do publics, you can do privates, you can do like a little bit of EM. I've been buying munis. I haven't bought munis in years. I've been buying long-dated munis the last couple of weeks. The yields are pretty good, we should talk about. Second thing, check these numbers out. If you take the top 25 companies, the S&P 500, so what's the Mag 7 are 35%, top 25 is gotta be 50, maybe a bit higher than that. The ROE is 56%. So meaning, people say multiple's high, I think the multiple's high. That being said, you work your way through it so darn quick. You look at the free cash flow and cash generation versus, by the way, this is 2005, 2010. You've never seen anything like this. And by the way, their leverage, they have no debt. So the point being is like, what shocks the system? You've got too much gearing, you got too much debt, and then you compound these returns. So you think about it, I could buy growth equities or I could buy tech, and I can marry it to income. And then the last thing I would say is, I heard, I won't say, somebody I respect a ton, who was on, I think it was on CNBC after who talked about economy's weaker. I don't know.
It was Jamie Dimon today was live on CNBC and said the economy's weakening, the consumer is weakening.
Yes.
Now, in context, he probably has been a little more publicly, at least, cautious about the environment for the past couple of years, but he gets paid to run his bank through all sorts of weather. Yeah. So he's looking out on the horizon and sees some clouds and says, well, if they come our way, we could have a storm. Right. But they don't always come your way.
Right. So, wait, what happened to my slide? Can I show that one last thing? Because I was so jazzed up about this. So by the way, I think he's a genius. I know him really well. I think the guy, he tends to be cautious. And by the way, there are parts of the economy that are softening, for sure. Here's what we've been running. 2022, you had almost 8% nominal GDP, 23.58, 24.5, 25.46. Nominal GDP, 4.6. Next year, we think the number's 4, you got a tailwind of fiscal. You're still 4.5, 4.6. It's pretty hard to be really upset. Like, you go back for years, we couldn't create nominal GDP. Last thing I would put on here, I don't know if you can see that chart on the left, where we have that last little blip. Vol, like we've run through some pretty highly volatile periods. You can buy, including today, You can buy put spreads, you can overwrite some of your stocks, you can trade the vol market and manage your, so when people say, are you hedging with interest rates? Like, why do I need to do that? I could use the vol market, and vol's pretty cheap. So I want to say one last thing, which is a little bit out of context. That chart on the right is inflation volatility. The Fed's mandate is not 2, it's price stability. And today, you look at where we are. Now, we had COVID, you had this big spike, obviously. We're ticking up a little bit to 3. It's just not that concerning. Like, yes, it was concerning in 2020, 21, 22. And the point being, when you take the grand scheme of things, I get a lot of income, I could use vol to manage my beta, I got stocks. And by the way, I'm so jazzed up about new sectors, the tech, et cetera, that it's the most fun I've ever had in terms of being in the market. Anyway, I'm done with my slides.
No, it's important because I think everybody here who's a financial advisor is fielding questions from their clients saying, where should we be? What is the best breakdown right now of a portfolio? Like, what does the Rick Rieder model portfolio look like today?
So anyway, I mean, people say is, Google or Meta, if you look at those multiples, given the ROE, and by the way, I didn't talk about this, free cash flow generation, people go and say, well, this is just like the valuations in the internet bubble. The free cash flow these companies are throwing off is unbelievable, and the ability to buy back their stock and invest in CapEx and data center, et cetera. So I still think tech is a winner. I'm getting more and more jazzed up. So anyway, I like being long equities, so I'm long stocks today. I've got, how do I describe this? We de-risk really quickly because I got put spreads and I overwrite a lot of the NVIDIA, Google, et cetera. So anyway, so I buy some downside in case we get like CPI tomorrow. If you got a 0.36, 0.37, will I knock it down? And then I buy a bunch of income and I just literally just clip carry. High yield, I buy a lot of Europe, swap it back to dollars. Great, I've been buying long dated munis, which by the way, long dated munis, they've rallied the last 3 days. But if you're comfortable, which I am now, that the back end's not going to get smashed, do I think the curve will steepen? But gosh, if you can buy back-end munis, 20-year munis at 4.5, 4 3/4 on a tax-adjusted basis, that's a pretty sexy asset. And then, then we own gold. I have about 3 to 4% gold, and I have Bitcoin, a fraction of that. But sort of that is the balance.
Munis are new for you,
yeah,
as a liked asset class.
Yeah. Yeah. So front-end munis, I don't really understand. I mean, by the way, nobody's going to lose money on them. They'll be fine. I just think you pay a lot on a basis, on a percentage of treasuries, and treasuries are much more liquid. But the long end, 10s and out, are now pretty attractive. As long as you feel like, no, it's not to suggest rates can't, the back end can't cheapen up a bit more. But boy, if you can clip now, tax adjusted 9.5, wow. That's, as long as you're willing to sit on it, that's a pretty good level. Munis, more than I know people follow them, own them for clients. It's the most mercurial market I've ever seen. Supply comes, the market gets hit, like happened in the last 2-3 months. Supply ebbs, and then all of a sudden, market does well. And now we're in, I think, a pretty good period.
You mentioned gold, which has been hitting record highs for the last many months. Does it just keep going? 4,000, higher than that? Like, where are we going?
So, I've owned gold for a couple of years, but I haven't owned it prior to that for a long time. We could debate where's the dollar going. I think the administration is more receptive to a weaker dollar than we've seen in the past.
They've said as much.
Right. So if that's willing, and if you believe, which I believe, the Fed needs to cut rates.
They've said as much.
Right. So, and then, if you believe that, you look at who's buying gold. So by the way, you look at the flows in China. China used to buy a lot of treasuries. They used to have $1.35 trillion of treasuries down to 700 going lower, and they're buying gold. India's buying gold. Poland, which I couldn't believe, is buying a load of gold. Central banks, reserve managers are buying gold. I think Bitcoin's not a great hedge against currency. It's certainly not it correlates with NASDAQ. So I think Bitcoin's going higher, but I think it's a different trade than gold is.
Mm. So you mentioned, where rates are and your expectation that they're going lower. What does the Fed do next week? And how does that match up with what you think they should do?
So I think there's a good chance they're going to go 50.
You think there's a good chance
sorry,
they go?
Hold on. So sorry, I should rephrase that. So the market today is pricing, because I did some of this, 9-1 against the Fed doing 50. I don't think it's, is it even money? Probably not. But it's not 9-1. If you take today, and I get pretty crazy about this, I think the price rate, the 4 3/8 Fed funds rate is priced wrong. 5-year inflation break-evens are 2.5. You get the funds rate to 3 1/4. You're still at a point you're above the inflation rate. If people, when you break down the employment report, 4 months, the average, so we've had, 22,000, doing this from memory, I think it's 25,000 jobs. Net of healthcare, it's running about negative 30,000 jobs. Healthcare is not cyclical. We have a hiring dynamic that's challenged and is clearly softening. And then you saw the revision today. We just revised down 75,000 jobs a month over the last 12 months. I get the idea we're fighting inflation. We're not going to bring down inflation because of the tariff transmission by keeping the funds rate at 4 3/8. In fact, what I think is dead wrong, low-income people in this country are getting killed because they suffer from higher goods prices. To say to low-income people, I know you're getting hurt by higher goods prices, we're going to charge you more for interest rates too, it'll be good for you in the long run, I think is crazy. What I think the next 5 years that people are going to talk about, that I think the Fed needs to change the narrative. You need to be a Fed, you need to be diligent on inflation. I think we're going to have a hard time getting more people to work over the next 5 years. I think AI is going to replace millions of people. I think young people, so by the way, anybody graduating college today trying to get a job?
Yeah, it's hard.
Brutally important. You break down the payroll report and you look at what's actually happening. By the way, you look at black employment has surged, their unemployment has surged higher. Young people unemployment is surging higher. Lower skilled is surging higher. We have, when people say AI is in the future, you look at these companies, Meta, Google, Microsoft, they're laying off people. And those are the best companies in the world today. I think if you're running the Fed today, I think the dynamic is, gosh, yes, we're going to have this temporary 3% inflation. It's not 6 like we were. But boy, what can you do to actually create a better framework that you're not creating this massive dispersion of wealth versus low income, and how can you be helpful in doing that? And I think that should be what I think the secular evolution of their thinking should be over the next few years.
But the Fed can't create jobs. I mean, how can the Fed, against the backdrop of AI and the disruptive nature of it, how can it contend with that?
So nobody can contend with the AI. AI is coming. It's going to displace a tremendous amount of workers. Simultaneously, though, the housing market is broken. So there are a number of things you could do. By the way, at Treasury, you can release a lot of land on the Treasury's balance sheet. You can create home builder incentives. Today, why do the home builder stocks, which I like today, but why have they come under pressure? Because you have to subsidize a mortgage to the tune of 200 basis points to actually sell a house. If the Treasury was to provide some incentives, and by the way, there's real velocity to this because you put 3.1 people to work for every house that's built in this country. If Treasury created some incentive, if the Fed got the mortgage rate down, and people say, well, you can't move the funds rate, that doesn't get the funds rate, that doesn't get the mortgage rate down. Actually, if you actually were thoughtful about the balance sheet, about how you use the balance sheet, if you can actually get housing velocity moving, it's actually quite powerful in terms of mobility of employment, and you're not punishing low-income people who have to borrow. And then, which I agree, we were talking about it earlier, listen, the president is aggressive about, do we need to get rates down 300 basis points? I don't know about that. But it is true that we're charging $100 billion to the American taxpayer to keep the funds rate 100 basis points higher than it needs to be. All of those things would help if you actually got it going. Will the Fed fix employment? No. But I just don't think trying to solve a short-term transmission mechanism in inflation is we're getting any benefit from keeping that funds rate there.
So you think the Fed should cut by 50 basis points next week?
Unequivocally. By the way, I saw it. One of the most famous economists, I don't know if he came out with it publicly, but I saw he was also talking about cutting 50. But yes, I think they should cut 50. By the way, people say, oh my God, financial conditions, the dollar. If you describe it articulately and say, listen, we think we're off today. We didn't have this employment data, which by the way was just revised down 75,000 a month for the last year. We had a different information basket before. We just need to move relative to that. This doesn't mean we're going to keep moving aggressively. We just want to adjust the price. I don't think this is this cataclysmic financial conditions, et cetera. As long as you articulate it effectively, I just don't think it creates that much pressure, unwanted pressure.
So a Fed Chair Rieder would cut by 50 basis points next week.
Whoever the Fed chair is should cut by 50. And I think it's crazy. I think they should do it. And listen, moving 25 basis points, the overnight funds rate, think about banks are asset liability matched. Nobody borrows off the overnight funds rate. Moving the overnight funds rate 25 basis points every 6 weeks doesn't do a hill of beans of difference. By the way, I think they should kill the dots. You know, that whole, we got to tell everybody what we're doing.
Get rid of the outlook.
What's that?
Get rid of the outlook.
Get rid of the outlook. And I've heard many famous central bankers who I have a ton of respect for say, one of the things you have at the Fed is the art of surprise. If you're trying to shock the system, you want to get a 50 done because what happens is people react to it. Debating, having this endless debate about, I don't know, we go 25, should we wait to September, October? Really? You're doing nothing. Just shock the system if you need to get the rate down. By the way, the mortgage rate, if you get the mortgage rate, we saw this when it got close to 6 or in the 5s. If it gets there, you'll see velocity of housing, which we need to have happen.
If we have a legitimate stagflationary environment, what is the Fed going to do about that?
So it is hard. And so, but I will say one thing. I believe that you don't compromise Fed independence by being innovative. You don't create, there are a series of things you can do with your balance sheet, how you use what part of the yield curve you're using, how you use liquidity. So today, the balance sheet of the Fed, which people freak out, the balance sheet's too large, it's 22% of GDP. The ECB runs about 40, Japan's 120% of GDP. 22% of GDP, by the way, if we grow 5% nominal GDP, the number gets down to 20 pretty quickly. It's not that scary. If you used it effectively, if you toggled, and I think this is where the Fed could really do some interesting things. Rate, balance sheet, liquidity, and then we could wrap into it, you know, what I think the Treasury's done around regulatory reform in the banking system. There's a series of things you could do to create more effective velocity than 25 basis points in the overnight funds rate. I think there's a ton that you could do. I'm always blown away. We finance commercial real estate, resi, auto loans, credit cards. The way modern finance works, sponsor takes the equity, the super senior goes to the insurance companies, we own the mezz, and it's really effective. And it's, the cap structure efficiency is incredibly powerful. And the Fed's just moving the 25 basis points on the overnight funding rate. It makes no sense to me.
People think that because rates are coming down, that the 493 out of the S&P are going to outperform, that the Russell 2000, for example, small caps are finally going to have their moment. You've been telling me for months that you don't get that at all, that you don't understand in any way the small cap outperforming or big pickup trade, and your slides that you show kind of suggest that, right? When you highlight for a reason the top 25 stocks in the S&P 500, you're making a point relative to the rest of the market, aren't you?
You're not going to believe this, but I'm actually buying some.
You're buying some small caps?
I don't like small caps. I don't understand it. They're growing their moat. Big companies grow the moat. I don't understand how you compete against big data. I don't understand how a retailer competes against Walmart when you've got all the data, inventory management, logistics, et cetera. I don't get the small cap trade. People say, well, valuation. Well, if your ROE is negligible, I don't understand what you're playing for in equities. You want to be down the cap stack. You want to be in growth. However, I don't own any. And so I've been buying some, and I've been doing it in option form. I've been buying some KRE in regional bank
The regional
form.
banks, yep.
The reason why I'm doing it is, first of all, banks. I've had a big position in banks. But you know, some of the big banks, like one we talked about, is trading at 3 times tangible book. Wow. Like, I get we're deregulating the banks. If you're going to, a big bank like that's going to throw off 18% ROE, you're paying 3 times book. That is expensive. So we've reduced recently some of the big banks. And, you know, if you believe that the Fed's going to do the right thing, then, you know, KRE, small cap, KREs we can debate. And by the way, I have a hard time finding a lot of great regional banks to buy. There are a couple, not many. But IWM is an interesting rate. And because I don't own any, I'm trying to get a little bit more neutral to a rate, different rate paradigm. So I've been buying some of the small caps. I don't like doing it.
I mean, so it sounds to me like it's more of a trade.
It's much more of a trade. We are going to be out of that trade. It's working out okay, but and I'm doing most of it in option form.
Okay. So when you look at the mega caps, is there a point where you say, despite the things you show on the slides, it's where all the activity is obviously with AI, is there a point where you don't like them? And what is that moment? What does it look like?
So, first of all, I think I'm about to have a grandkid, so that changes my perspective on everything, by the way. But I think I've always said we got to tell our grandkids, and like now I get a chance to actually do that. But I think we're going to tell our grandkids about this was one of the most extraordinary periods where you had a changing industrialization of certainly the U.S., but arguably the globe. What is, and we could debate market power of some of these entities, but the fact that you throw off this sort of free cash flow, it's not the internet. I hear Jeremy Siegel is my old professor. I think he's brilliant on this stuff. This has nothing to do with an internet bubble. Or these companies like Meta, Google, I mean, they still trade multiples in the mid to high 20s. It's not that bad. I mean, if you trade, I mean, we could debate NVIDIA and we could debate some of the multiple there. You could certainly debate Tesla. Although I think it's a pretty cool company, but we could debate where that is today. But I don't think at mid-20s, if you throw off that sort of ROE and can buy back that much stock, I don't think from a multiple point of view, those stocks are too high yet. In fact, there's an incredible chart that I didn't want to bore you with too many today that shows that actually what's happening is the multiple of those companies is actually coming down because they're earning, you know this better than anybody, they're earning faster than the multiple can keep up with.
Right. Well, that's the NVIDIA story for
Totally.
a large part. They're earning so much, their multiple had kept coming down, not going up.
Right. I'll tell you the one I have a really hard time with today. You know, semis, you know, I think there's some dispersion. We spent a bunch of time with Broadcom and NVIDIA and thinking through. Obviously, analog is very different today. The one I really have a hard time with is software. So we have some positions in software, but it's very hard to figure out where does AI, who does it displace, and who is well positioned. We have views on it, but software is very, very hard today. I will throw the one that I think is crazy exciting.
Yeah.
I think what people are underestimating is satellite technology. You saw the EchoStar announcement.
Right.
I think satellite is going to be an incredible how data transmission works in satellite space. That's the one you have to do most of it in private.
Well, I was going to ask you, because obviously you think of Starlink, but what part of your portfolio is in private? Like, how are you thinking about that?
So my global allocation, so depending on which fund, so 10 to 15%. But the places I like to, in equity, the places I like to use it, satellite I think super exciting today. Parts of the AI ecosystem I think are super aggressive today. Would I use that equity private for an industrial? I wouldn't. And then in credit, I mean, we do a lot of real estate finance, bespoke finance, and you still get really good terms.
Data centers?
Yes is the answer. Yes is the answer. We have some vigorous debates about technology evolution, but I do think data center finance, we just did one. Yeah, as long as you're getting paid effectively and you know who your counterparty is, I think it makes a lot of sense.
When you look at the valuations in the private markets of, say, an OpenAI at $500 billion already, and these companies are raising at post-money val, that's just unbelievable. None of that makes you sit back and say, as bullish as I am, this is getting kind of crazy now.
So I think it's really, so this gets to the point of like, what is multiple on that? I think you're making, no doubt, you're making a bet on the future evolution. It's a lot harder to me than saying, what is Google or Meta at a multiple where you're throwing off real cash flow? Listen, I think AI is going to change the world faster than people think. It's why I am, I'd be aggressive to say freaked out, but I am intensely sensitive to the employment dynamic in this country today, because I think we use a ton of AI in our business today. You think about what we're able to replace on research, things in HR, legal, administrative function. I think it is extraordinary. By the way, when I throw out AI, robotics, automation, I think the world is going to be in a very, very different spot 3 years hence. Scary in many ways. But evaluating companies like that, listen, we have some positions in ones we think have, without giving it, that we think have a better chance, that have a better, that is one of them, but that have a better ecosystem going forward to win.
OpenAI is one of them.
Yes, sir.
I mean, how are you thinking, generally speaking, about the return on investment of the tremendous CapEx numbers that are being spent by the hyperscalers? Do you even care? Should you care? Or is it just too soon to care?
So I will say one thing about investing, it's all about timing. We're not going to have the answer to that for a while. So I know for the next, I always think about in 3 to 6 month increments, where am I going? I don't think we're going to have the answer to that for the next few months. My sense is there is so much infrastructure that has to be built, and energy and cooling, that my sense is the ROE on it, should benefit from all the amount that's going in. But I know for certainly the next 6 months to a year, we're not going to know the answer. It's going to take a long time.
Gosh, I thought I was prepared for you to say for the next few years, not few months, that we won't have these answers, because I don't see how we could even have those answers within months.
That's fair. It's fair. I just think about certainly when I'm buying public assets, I'm thinking about I have to generate return. I have a lot of people that care about what we do every day, but I always think 3 to 6 month increments in liquid assets, and where am I investing for?
Since you mentioned software, we've been debating on our show repeatedly now whether AI, and it seems to be the conversation, whether AI is killing software. Now, you alluded to it in the sense of they're obviously not all created equal. For every snowflake, there's a Salesforce. For every MongoDB, for example, there's an Adobe. I'm not making apples to apples comparisons, but I think you get the idea. Ones that are working and ones that aren't. Revenue and business models that are being disrupted, margins are going to be impacted. How do you do the work to figure out what you think are going to be the winners in what was a really loved space? Then it got bombed out pretty well, and now we're having this debate on which are going to be the winners and the real losers.
So we spent a ton of time on it, and I will say the only way I've been able to assess it is that company, is it entrenched because when a big customer, Salesforce being a good example, Intuit being a good example, Autodesk being a good example, companies that have a specific expertise that is hard to replace, and or it is business driven, and you become so entrenched in a company's ecosystem that it's hard to get you out. And then obviously, where are those companies in implementing AI into their broad framework? So that's how we're doing it. But it is definitely an imprecise science today.
What do you think are the biggest risks to your opening statement that this is an incredible time to invest? It's one of the more exciting times that you've ever seen. What's the risk to that?
So I will say I've been investing for 40 years, almost 40 years now. They usually don't give you a heads up on the stuff that's going to come down the pike in terms of whether it's geopolitical, whether it's deep-seek-ish. Like, you don't really get what I worry about more than anything. The debt in the country, that is a big one. Can we keep rolling auctions? But I think everybody knows about that one. But I worry about complacency. So we just did a financing in a residential pool, and somebody came in a private credit space that had to put the money to work. We did the super senior and the senior tranche, and they said, we'll go 2 notches lower and we'll pay through what you're paying on the senior. And they said, we just got to put the money to work. And that freaked me out. and you see some more PIK financing. You see people who have to put money to work. There is some overzealousness around, I got to get the money in the market, and some complacency. Listen, our positions in NVIDIA, Microsoft, et cetera, like everybody, are pretty big today. If there is some slip up, some regulatory or legal, like the Google news, I thought was a really big deal because it took that cloud out.
Well, look, the stock has ripped since that day.
Yeah. So, listen, it's the exogenous shock. Regulators usually prepare, markets prepare for what happened yesterday. It's a thing that is, and complacency. You know, I believe, and I don't know if y'all follow the Minsky cycle of how markets work, but it's amazing. You have displacement, you have boom, and then you have this period of where complacency kicks in, and that's usually when the market comes under pressure.
You think we're too complacent, since you're talking about that, and since you mentioned DeepSeek, about the Chinese and their efforts in AI? They're not rolling over and just saying, okay, US, you guys are going to be #1 forever. Don't we have to believe that there are other DeepSeeks in the works?
So first of all, in China, like I have some positions in China. I don't have, for a variety of reasons, I don't have huge positions, but I have some positions. I think the technology there, including, we talked about space and satellites, the technology is extraordinary in many parts of what China is doing. I unequivocally think, so think about all the data center investment, the CapEx. If you created more efficient, energy efficient chip, like that changes the ecosystem quite a bit. So I think you always got to be on alert. You always think about what's our exit strategy on some of these positions or sector allocations. But yeah, I think that is out there, and I think something is going to disrupt certainly over the next few months.
Do you think that the bond market's going to have one last not so fast moment? The long end spikes, it freaks everybody out. In anything that can happen in that regard, where it could be disruptive to the equity market?
I think it's the highest tail risk that there is out there. So I do these monthly calls. I'm doing one on Thursday. Can I give you a couple of cool stats? And so these are equity stats, but I'll relate to why it is. Do you know the S&P 500 since March 9th, 09 is up 1,200%? What percent of the days do you think the market's up?
What percent of the days since then?
Yes. Do you think the market is up versus down?
75.
Who said it? Somebody said it. What'd you say? 54.7%.
That's it.
So the market's up 1,200%. 1,200%. So we're up 54.7% of the days the market's up. Okay, here's another crazy stat. And by the way, you mentioned earlier, Tony P. at Goldman helped me with this one. If you took out the day before the FOMC and the day of the FOMC, I think it's the last 30 years. What do you think? If you didn't invest those days, what do you think the S&P 500 would be trading at today? 2,800. Okay, so it's an unbelievable statistic, meaning, by the way, the Fed has a big influence over the equity market, tells you that.
Yep.
Second thing is, the reason why I relate this, listen, we could spend our whole lives worrying about this thing is going to happen. You got to stay in the game. You just got to stay in the game, and then you got to think about what is your exit strategy. So do I think the long end is a risk? Yes, I think the long end is a risk. So what do I do with it? I mitigate the amount I've got in the back end, because to me that's the biggest tail risk I've got. I buy a bunch of put spreads on the equity market. That is one that, yes, could we make another run at that? My base case is no. I think we've seen it, and I think rates are coming down, but it's certainly possible. But I think people underestimate, we get, social media all the time. This is a disaster, that's a crisis. If you miss particularly fixed income today, let's say I'm wrong on rates. If you're clipping 6.25%, I make 50 basis points a month. If rates go up 20 basis points, I make it back in a couple of months. So point being, we got to stay in the game and then think about what's your exit strategy and what's your downside.
Where do you think the 10-year is going to be if we're sitting on the stage a year from now?
What range can you give me? So I would, so there's a big disagreement about this, even including internally. Listen, I think the 10-year is going to be 3.5 to 4.25.
And where do you think the mortgage rate? Where do you think mortgage rates are going to be?
Is this a lightning round that's too hard? Can we go back to
Come
talking
on, you
about...
have to be thinking about that. Yeah.
So I think it's coming
Your
to-
thoughts about housing are pretty profound. I mean,
Yeah.
it's a key part of your story.
Yeah. Listen, I think the mortgage rate's got to come down. I think it's gonna come down. Listen, if we could just get it to the high fives. So this presentation I'm giving Thursday, I show actually how you change housing velocity once you get in the fives, and then it will blow people away. We just got to get it down because there's such a latent demand for people to move that if you just get a little bit of impetus, then you'll see some real velocity in housing. And we have to, if you're a young person, young, lower and middle income, the chances you're building wealth, buying a house, creating employment velocity is brutal today. We got to get that rate down. By the way, I'll throw out last thing. People underestimate financial crisis and otherwise, the housing market, it's 3/4 of the wealth of people in this country by person, not by aggregate. But we have to get housing right.
I wanted to get exactly where the S&P was 65, we'll call it 6,500. So a year from now, this is the last question of the lightning round.
Come on.
A year from now, what makes reasonable sense, do you think, for the S&P? You don't have to give me like a hard number because that's impossible to do, but even for somebody as great as you.
Yeah. I say, listen, I think, okay, so Citigroup put out a great report that talked about the ROE, the true ROE of the S&P 500, and I think their number was 23.5 ROE. So if you said to me today, the ROE is 23.5, you said maybe we compress multiple, maybe the economy slows, though I don't think it will with the fiscal tailwind. Listen, why can't I get a 15 out of equities? And all I'm doing is your book value accretes. By the way, not only your book value accretes, you reduce your book value because you buy back so much stock. Like to get a 15 a year hence doesn't strike me as a long putt. Like
So you're not one of those who believes in like just get ready for below average returns in the years ahead. You're
By the way, I
you're
think
the
it's
opposite of that.
I think it's below average of the ROE. If your organic ROE, listen, if I'm running which I guess I am, if I'm running a portfolio, would I orient it to the companies throwing off higher ROE? By the way, it's not just tech. I think leisure and hospitality is incredibly exciting. People are going to have more time on their hands. I think leisure and hospitality is interesting. I think European financials, like if you orient to some better asset, better places to invest, I think, could the 15 be 20? I think so.
All right. I think we'll leave it there. You gave us some really good things to think about. I hope everybody has a great takeaway on
man.
what the current investing landscape looks like according to Rick Rieder. Thank you.
I appreciate your having me. Thank you.